Let's now welcome our market master for the morning, Vibhav Kapoor of IL&FS. Good morning, Vibhav. Thank you very much for joining us. Well, we have seen some fairly decent macroeconomic numbers coming in, inflation falling. Are things building up to the index possibly crossing 8,600, the previous high, before the quarter is out?
There's no doubt that the macroeconomics, I think, are in much better shape than we've seen for a long time, partly because of the oil price falling, inflation falling, and partly because of a stable government. So things on the macro front are really looking very, very good. However, getting that translated into corporate earnings, I think, is taking a little bit more time than what the market had expected earlier. So the kickoff on the on the ground economy, I think, is a little bit delayed as compared to what the market thought earlier, and therefore we feel that there will be some earnings downgrades for FY16, maybe marginal, but I think the street was at, consensus estimate was at around 570, 580, which may come down to 540, 550. And to that extent, the upside for the market is probably gone down a little bit from what we had anticipated earlier. Having said that, of course, the medium-term outlook continues to remain extremely good. So all that is happening is probably that the uptick is getting a little bit delayed and maybe a little bit back-ended.
Okay. Vibhav, hi, good morning. So if you are expecting marginal earnings downgrades, which are the pockets which could face pressure, you think?
Well, part of this earnings downgrade is happening because of fall in oil and metal prices, and therefore those are the sectors which could see some earnings downgrades. Part of the downgrades could happen because, as I said, there was too much of expectation that things on the ground would improve very quickly, which is not happening. And for example, capital goods, that capital expenditure improvement probably will take some more time, and you could see some earnings downgrades there. Also remember that in FY15, in the last quarter, the government is probably going to cut down productive expenditure to meet its fiscal target of 4.1%. And that means that the last quarter of FY15 might not see that big GDP growth uptick, and therefore that will delay matters a little further.
Okay, so what should the likely gains this year be? Nothing like the 30% we saw. This is likely to be a more modest year, you think?
Yeah, definitely. I think 30% is going to be really difficult to achieve this year. I would expect anywhere between 15 to 20%, depending upon how global factors pan out. And this is largely based on the fact that the market is at a reasonable earnings valuation at this point of time, and you could see about 15% earnings growth from in FY16, and therefore you could see an appreciation of anywhere between 15 to 20%.
How many rate cuts, or how much by way of rate cuts, are you factoring in, Vibhav? And how would that translate into stock picking?
Well, I think average inflation for next year, that's for FY16, should be in the region of around 5.5% or so, which would mean that if you have a real interest rate of 1.5%, you could come down to about 7%. So that means effectively a 75 to 100 basis rate cuts in FY16 is what we would expect.
Okay. You spoke about how the fall in crude could result in downgrades for certain sectors, but on the flip side, it will result in a margin expansion for many sectors as well, the likes of paints, tires, etc. Would you make any fresh investments into those spaces?
Oh yes, there would be definitely a big gain for some of the sectors. As an example, cement, where diesel prices are coming down, freight costs could come down. Coal prices are coming down, at least imported coal prices are coming down. So there will definitely be a lot of sectors. Paints obviously is one where, so wherever oil-based raw materials are there, you would definitely see an expansion in margins, and those sectors would definitely do well.
You didn't tell me how you would translate the rate cut in terms of stock picks.
Oh yeah, I mean, you have to be in the economy-related cyclical sectors. That's where you have to be overweight. And obviously, as we've been saying for a long time, financials, whether they are banks, private sector, public sector, housing finance companies, NBFCs, that whole financial sector, I think, is a sector which should do extremely well in FY16. And if these rate cuts come through, all the more reason for that to happen. So that's the sector one would be overweight on. And of course, then you have the other cyclical sectors like automobiles and maybe even a little bit of light engineering. Those are the sectors which one would like to be overweight on.
Realty?
Well, realty is one sector which I don't track, so to be honest,
okay.
I am not really.
Okay.
I don't have any comments on that. But as a macro story, it should definitely gain.
Vibhav, what is happening with a stock like HUL? I mean, I understand that lower commodity prices will benefit it, but is there any speculation of another open offer by the parent? How would you approach that stock now?
To be honest, I really don't know whether there is any speculation about another open offer. But I guess large part of it is due to the fact that a lot of raw materials for that company are oil-based, and therefore the company is really going to gain a lot because of fall in oil prices. And also, obviously, you do have this expectation that as the economy picks up, consumption is going to pick up, and that is going to help companies like Liva.
We have a money control boarder giving us a question through the message board. Sujit Kumar Kamath has written to us from Kochi. He wants to know if it's a good idea to invest in stocks like PNB and Tata Power.
Well, as I said, we are definitely overweight on banks, including public sector banks, and obviously the larger ones are going to be better placed. So banking is a sector which definitely we would advocate investing into for the whole of FY16. Tata Power, I am not so sure because they have a lot of other issues and they could actually stand to lose some of their advantages in FY16. So I'm not very positive on that.
All right, Vibhav, as always, thanks for joining us, and that note of caution is taken. There might be some earnings downgrades in FY16.